the riskiest thing to me is in 3 years, you buy companies that don't grow. And then, you lose money, or you lose versus inflation. The theory I kept coming back to was low marginal cost, that these companies had low marginal cost qualities. So the cost of one additional unit was nothing, right? Like, what does it cost Visa when you swipe your credit card for them? Nothing. They make like a 2% fee. What does it cost Microsoft when you go and download one additional Microsoft Office? It costs them nothing. It's 100% profit margin. We all know what software does. It automates. But then you're not charging a subscription for it. You're actually just taking a little fee of the money flowing through the system. So that is the digital toll booth. And I think that's the future of software. You want to own companies that are profitable and that can continue to grow and scale into the future. But the biggest thing is that they can continue to grow the value they provide people. So they're not just growing their revenue, but they're growing the utility they provide all their customers.
Hi, John. Welcome to Excess Returns.
Hey, thanks, Justin. Thank you for having me.
We wanted to have you on to talk about how you invest at AOT Invest, and specifically the AOT Growth and Innovation ETF that you run, ticker symbol AOTG. And we thought it would be a good time. The fund recently hit its 3-year track record. And so we thought it'd be fun to have you on to talk about the investing process that you go through to find these fast growing, sustainable businesses and how you build a portfolio of these companies. Because obviously as investors, we have to balance, this risk and return with some of these businesses. And I think that's going to be an interesting thing to kind of focus in on with you today and how you sort of balance that, but also sort of the opportunities that you're seeing in the market and what innovation means in today's market. There's a lot of innovative things happening that we'll probably get into, and that'll be fun to talk about because I think a lot of investors are interested in this stuff and how these companies are benefiting and how investors can benefit from these trends and in terms of long-term performance. So anyways, that's kind of the thrust of the conversation. It'll be a good one. People can learn more about your ETF. They can go to AOTETF.com. That's where you can learn more about John's investment process. So anyways, where I want to start, it's, we were thinking about the conversation with you, and this is a great thing. I mean, you're a very, you're one of the younger investors we've had on the podcast. And so we kind of thought it'd be good. Like, what brought you into this? I want to launch an ETF and I want to get into this business. Like, how did you get here?
Yeah. So I've been doing investing for, since I was in high school. Right. And I'd like to write my papers like in economics, things like that, including in college. I'd like to write them on like companies and which ones I thought do the best, right? Like would oligopolies outperform, other types of markets, things like that. So I'd like to buy the stocks on my own. And eventually, I was doing that, over time for my brothers, and then I was doing it for my parents. And so really I was investing myself and my family's money. Right. And that was really interesting because you learn a lot along the way, and I've always been really self-reflective. So whenever things didn't go right, you always ask yourself why. And when other things go really well, you always ask yourself why. Should I do more of this? Was it a one-time thing? Was it repeatable? So, I studied economics and investments at Northwestern and University of Oxford, and then I went and worked for a family office in Chicago, and then was a proprietary market maker. And the proprietary market making side of things really stressed the importance of probability analysis, because like when you're market making, you're just doing a ton of trades. The whole idea is, you might be trading 10,000 trades a day or more. The whole idea is to get that tick of edge and basically to win in the long run, but know that you lose, quite a bit of the time also. And so, I like taking that approach and taking that to actually portfolio management, which is just saying like, if you were to lay out the expected outcomes of these stocks, how do you get the best one? And so like the best place to look is like back at history. And like, I'll give you guys some like personal examples of where I started. So like in 2008, when I was doing this, right, Apple was one of my biggest positions, and it was for a long time. So since then, Apple's up I think it's 8,000%, right? And Boeing was also a big position. My theory there was that it was an oligopoly, right? Boeing and Airbus, so it was going to do better. And that's only up 180%, right? Then I had this theory that, there's going to be a real estate shortage. There's only so much. It's a valuable resource. So I bought the Vanguard REIT Admiral, that's up 80%. Meanwhile, the tech index, since 2008 is up 1,900%, right? So I kept seeing these same things again and again, that technology did better, that Apple did better, that Visa, Visa is up 2,700% since then, while it owned a fertilizer company, which was like Potash Corp, which then merged and became Nutrien. And that's basically flat since 2008. So like, why do you see this again and again? 3M up 100%, but Microsoft's up 3,000%. And the theory I kept coming back to was low marginal cost, that these companies had low marginal cost qualities. So the cost of one additional unit was nothing, right? Like, what does it cost Visa when you swipe your credit card for them? Nothing. They make like a 2% fee. What does it cost Microsoft when you go and download one additional Microsoft Office? It costs them nothing. It's 100% profit margin. And so, like, is it any surprise that they can grow without any debt, without having to build new factories, not only do they not grow without any debt if the demand's there, they also grow with 100% profit margins on new sales. So they reach higher levels of profitability. They take on less risk because they don't have any debt. And they can grow much faster because there's no barriers to growth. And so the biggest thing of it all also is that, one, their product already exists. So every dollar Microsoft puts back into like Microsoft Excel or any other suite, they make it better. So every dollar they're putting back into it, it's always improving. It's always growing the value it provides people. Meanwhile, how much does it cost Boeing to build another airplane? Like, I don't know, 99% of what they can sell it for. So like they can't innovate very quickly, right? Like they just have to keep buying the steel and building the next airplane. So these companies, not only are they more profitable and they grow faster, they also innovate at 100 times the rate. And like at the end of the day, I think like when you're investing for a multi-year period, mathematically, that is like impossible to argue with. And that's really good. I think the key is like when you're doing this is to focus on the profitable companies that are already, showing good revenue growth and not focusing on the ones that, you think will. So basically like I looked back at history and I looked back at my own investments and I continued to grow the portfolio I was managing. And then you guys know about ETFs, right? Like you don't have to pay capital gains when you have custom create and redeems. So eventually it was like, we're recognizing a lot of capital gains. Why don't we just roll the strategy into an ETF? And then it can continue to grow and tax deferred. And that's going to have a really good benefit for the shareholders. And so then, rolled the strategy into an ETF when it got big enough. And since then, right, I think it launched with like $20 million of assets. And now it's at, 3 years later, $75 million of assets. So it's growing, right? And, the shares have done really well. So it's been really good for shareholders to never recognize a single capital gain since the ETF is launched, unless they sold the ETF share itself, right? Yeah, so really it all came out of the reason of launching the ETF had to do with tax efficiency and also building a scalable low marginal cost business yourself, right? And then the other part of it had to do with just making this this investment vehicle easier to manage and easier to take on more accounts and serve a greater number of investors to help them do better.
Yeah. So I'm just curious. I'm sure you mentioned you manage money for your family. So you're still, you did well. You're still invited back for the Thanksgiving dinners, right?
Yeah.
Everyone's happy? Okay, just making sure.
That's right.
Nice.
But, it's good. We have a family fertilizer business. I was talking to Jack about this before we started. So I'm actually sitting in the office of the family fertilizer company. It has 150 employees. So Jack and I were talking about value investing right before this started. And I was like, this would be considered a value company. I'm really well aware of how you run these things. And I think the interesting thing about agriculture is that it's, as Jack and I were talking about, it's like brutally competitive. Like the margins are tiny. The growth is like really, really difficult to have growth in the business. And so I think it gives you like it gives you a really good like look into management and what you want to look for in companies, but also it teaches you to just be laser focused on providing value to people at the lowest possible costs being incurred. And that's really good. And ag has actually spawned a lot of great investors, right? Like the Simplot family were in ag, right, in Idaho. And they actually were, I think they made like tens or hundreds of billions on Micron. They became like the majority or, they own 40% of it. And then there was like Doug Burnham, who's the Department of Interior Secretary now, and he started Great Plains, but they actually That I was largely, bought and started by the Burgum family, which is a agriculture family in the Dakotas. So I think there's a lot of really good lessons to learn from agriculture and from value investing in general, and then applying that in a way that's scalable for growth in the future.
How do you think about, to your point about the very low cost, high margin, your example on Microsoft, or Visa, somebody swipes the card, it doesn't cost Visa anymore, but clearly they make, a profit off that. But kind of relate that to like AI in the sense that there's obviously this massive capital build out right now with OpenAI and all these different, large language model providers. So there's clearly a big investment. We don't yet know really who the winners are. Most of these companies aren't yet public, but how do you think about that? Like with, in relation to looking for those other types of companies with those qualities. So I'm just curious, this is a new industry, an innovative industry. Obviously, you'll probably want to find the winners there, but it's still young. And so it's still early on. How do you kind of think about that?
I mean, I like to focus in the revenue growth, right? So if the revenue growth is there and the earnings growth is there, right? They're profitable companies that are growing their revenue fast. That creates a really good, right? It's important that they're profitable, but, and I think that takes a lot of the risk out of technology investing and lowers the volatility of the portfolio, substantially. But, look, if they're profitable already and there's high revenue growth, and that revenue growth is coming in at 100% margins, right? That the earnings growth is going to be big, and or that has the potential at least to be very big. So, right, like you can see that like NVIDIA, maybe they double their sales over, or maybe they 2x their sales over the last 2 years, but their earnings are actually up 18 times, right? And now that is the power of low marginal cost, the additional sales coming at high profit. So high profit margins. So basically, like when you make a portfolio, you want to have that fat tail reward, right? So you want the tail reward to be as big as possible. And you want those companies that have the potential to go up by 18x and earn 18x more than they did 2 years ago. At the same time, you don't want them to have the potential to go down quite a bit. And, any company that's unprofitable has the potential to really whip around and go down quite a bit. So managing that and putting that into a portfolio with respect to the valuation metrics and trying to focus on the valuation metrics, I think is the secret sauce here.
I want to take a step back and talk about AI in general, because as I mentioned to you before we recorded, I'm a value guy. And so I have trouble thinking about these technologies. And it's just whenever I listen to like the All In podcast or all these other podcasts, it's like just the things this could be are just amazing to me. And I'm just wondering, as someone who's investing in this space, like, how do you think about AI? I mean, people equate it to the internet, people equate it to like electricity, one of the biggest innovations we've ever seen. Do you have any context on that?
I'm really excited about it. And the reason why I'm excited about it is I don't get too lost in the weeds. I try to stay pretty macro on it and just take a big 10,000 foot view. So I guess almost half of ChatGPT's questions are being asked are programming questions, which I find so interesting because that's of all the questions. So that's me, you, we're all asking ChatGPT whatever questions. And we don't even make up half, right? So there's all these programmers that are using it every day. From my understanding is it's lowering software development costs by up to 90%. Companies like JP Morgan are rewriting, programs, and they're saying it's saving them 200,000 hours of programming time. And so here you have AI and it's lowering software development expenses substantially, while at the same time increasing the rate of innovation, right? So first of all, we all know if a company has less expenses, they're more profitable, right? So now you have companies that are going to be making more money while at the same time innovating faster. I mean, can you imagine that? Just think 10 years forward. That's great for shareholders, right? Not only do they incur lower expenses, but they're also, innovating and growing faster. That's just a wonderful makeup. And so, the interesting thing is the tech sector. So XLK is an ETF. It's up annualized 22% a year for 10 years in a row, right? So that's the average over the last 10 years. The question going forward is, could it do even better than that over the next 10 years? And, I think the problem with the tech sector is one, it only weights by market cap, which I think makes no sense at all. When you really want growth, you would want to wait for growth and you'd want to wait for evaluation metrics. But the other thing about the the tech sector is like, I find it like insulting that companies like Google aren't in it, right? You're like, wait, this is literally like information or technology that I use to find information. How is this not in the information technology sector? Oh, no, that's communication services. So like when you invest in a sector like that, you're actually missing a lot of like the crucial AI technology. And so the interesting thing is how these sectors have come out is that you really need like a thematic cross-sector play to have good exposure to it. You can't just get it by investing in the software sector or the technology sector. So, that's what AOTG sets out to do, to give you that cross-sector. And obviously, like the way you can define that for me is low marginal cost. And then how do you know if they're, really providing value to people, with their AI? Well, they're going to have revenue growth if they are. So like, there you go. You have two pretty easy screens. And on top of that, then you start like applying valuation metrics on top of it, which is the exact opposite of what an index does, whether it's like the NASDAQ 100 or like the S&P 500. And like, I think like a good analogy of that is Palantir and Toast, right? So you have like Palantir and it has a price to sales of 100, and you have Toast and it has a price to sales of 4, right? But they're both growing their income, whatever, it's 70% year over year. And they have similar revenue growth, and Toast has more revenue. And like no great investor like Warren Buffett or anyone would be like, well, I'll take 25x more of the more expensive one. Like you of course would want to wait towards the cheaper one and you'd buy more Toast. Like if you had your own money and they're like, hey, by the way, Jack, do you want to buy this $4 million business? You've got this company with $1 million of sales. Do you want to buy Toast for $4 million or do you want to buy Palantir for $100 million? Nobody would be like, let's pick that $100 million Palantir, in my opinion. So like I apply that in AOTG. And I think like in the long run, you miss some trendy, or in the short run, you miss some trendy stuff. But in the long run, I think it's really going to help you have good performance is my hope.
Yeah, your point on sectors is a really interesting one because we've talked to a lot of investors, and I think people are going away from like using sectors as a tool to analyze where their risk is. Because first of all, as you said, like there's technology companies that clearly are not in the technology sector. There's companies that you really can't classify, but also there's such a diverse group of companies within the technology sector that you can probably diversify a lot more within technology than you used to be able to. So it does seem like maybe like looking at sectors is not the best way to look at risk.
Yeah, I mean, I wanted to launch a software ETF, and like I wanted to include, and by the way, I'm about to file a prospectus for a software platform index, but I wanted to launch a software ETF, and I wanted to include companies like Google, and like I was like told, no, you cannot do that. That's like, but Google's like a software company. We all know it is. And they're like, no, it's not a software company, guys. That's so I have this new name called software platforms. And that is a very good definition for software platform companies. So hopefully you'll see that index come out in December.
Going back to AI, how do you think about investing in a huge disruption like that? Like if I go back, like I kind of came up during the .com thing. And, if you look back, there's two things that are true. One is people made massive amounts of money that bet on the right names. The other thing is a vast majority of the companies didn't work out. Like you've got the pets.coms of the world that just didn't work out. But how do you think about that? Like as you look forward with AI, how do you think about that idea and how it's playing out now?
Yeah, I mean, we don't even have to look back to like the .com bubble. We can just look back to like 2022 and like look at all those IPOs that were unprofitable and just got absolutely murdered in 2022, right? And so like, I think that the difference now is that the big companies, whether it's like Microsoft or Google or whatever, not only do they have like GAAP earnings per share growth of 20% plus annualized, which is like really high, historically, but like the companies that you're saying, oh, maybe we shouldn't invest in them, like Procter and Gamble, like they have no GAAP earnings per share growth and they have a higher PE ratio. So like, that's a little problematic. And so like, I think this time that it's being done profitably. And I think that you don't have to focus on the unprofitable companies. You can just focus on the profitable ones. And you see, like basically like you're always going to pay a little bit more for growth, right? And you should, right? If a company can grow their earnings at 100%, their PE ratio the next year is going to be halved. So like you're always going to be willing to pay. We have very, very high growth in like the tech software platform, AOTG sector, right? And so like, I mean, for the last 3 years, we've been hearing about like a recession coming any day now. Is the recession going to come? The tariffs are here, recession. Meanwhile, like the NASDAQ's up over 100%. So like there is a sector of companies doing incredibly well. And that is that low marginal cost sector of companies. And just like AOTG launched in 24s in June of 2022. And now I think it traded in the 55s today. So like these are companies that are, they're financially very, very healthy, and they continue, I think like the average weighted earnings growth in AOTG, the last time I like went through all the earnings and did it, which was like a month ago, was I think like 85%. So the company on average, their earnings are growing 85% year over year. And that is, that's really high. I think in the S&P 500, it's like 5% year over year. So it is kind of like, there's a sector of companies that are in that ultra growth mode, and AOTG tries to capture that.
Yeah, and one of the interesting things, going back to the idea about the dot-com bubble, is we all have this tendency to look back and say, well, history is going to repeat itself. But there are, and I'm the value guy, always shaking my fist at these bubbles and stuff, but this is a very different world. I mean, these are much better companies.
Yeah.
There's much more profitable companies. I mean, if you look at NVIDIA relative to the valuation of Cisco, it trades at a much discounted valuation.
Yeah.
Like you can argue overvalued or not overvalued, but this is not the same thing as that.
Yeah, I mean, the interesting thing is that like the NASDAQ, or just like talk about the QQQ ETF, right? Like the only time it really meaningfully underperformed the S&P 500 was that like 2000 to like 2002 era, right? After that, like once the NASDAQ generally turned positive, I mean, positive like in profitability. So like the majority of the companies are actually making a lot of money. It's crushed the S&P 500. And now I guess the NASDAQ, the average profit margin is 16% in the NASDAQ weighted. And in the S&P 500, it's 13%. So the NASDAQ's actually a more profitable portfolio, which I think is interesting. And guess what? Because of that, it performs higher for shareholders. And it has companies that are much more scalable, I think, on a whole. So I would expect that, I expect that to continue.
Before we dig into your strategy a little bit more, one more on the overall market, I want to ask about this idea about, this is something I think about and I ask guests about all the time, is this idea that if you look through history and you look at the top 10 companies in the S&P 500 every decade, they're almost always different. Like when you go to the next decade, there might be 2 or 3 or something that are left, but most of them are gone. And I wonder about how that applies to where we are now, because as I sit here today and I look at these biggest companies, it seems to me, and maybe it seemed to people like that in the 60s too, but it seems to me like these companies have bigger edges that maybe those companies in the past did. It seems to me like it's more likely than it has been in the past that we might see some of these same names 10 years from now. But I'm just wondering, as someone inside of tech, do you think I'm right? Do you think I'm wrong? What do you think about that?
I think, first of all, the laws of numbers, is that what they call it? Like once you're so big, you can't keep growing, right? There's got to be some truth to it, first of all. But the other side is that it doesn't apply as strongly with low marginal costs. So high marginal costs, like imagine like you're Boeing and you're making airplanes or whatever. Like, or even like you're like the Getty Oil people, you're buying up all the steel, and people are like, oh my gosh, the demand is so high, we can charge them whatever we want. So they start charging more. Or like say you're the oil company and you're trying to buy up every oil lease in the United States. Eventually people are extorting you for the additional sales. They know you're desperate to keep growing and sell it. So eventually you're raising your costs, right? Very high. So your cost per unit is actually going up as you're trying to grow. Just like how Boeing needs to, build more factories and to keep supplying airplanes, and they need to expand their supply chain. It's very, very expensive. But low marginal cost, it's the opposite, right? So like your cost to grow actually for each additional unit keeps going down. So like Apple, right? Like they're like, hey, we've got this phone. Why don't we throw Apple Pay on top of everything, right? And like basically it doesn't really cost them anything. And all of a sudden they're capturing transaction revenue. And so there's not any cost really to growth there. So they can, and then every dollar they put back into the product, they continue to innovate and come up with new things, right? I mean, just think about how Apple has gone from basically this huge computer the size of a room to basically everything they have today, and inventing FaceTime and iMessage and all that, right? And meanwhile, ExxonMobil is still just making a barrel of oil. You know what I mean? Think about the innovation difference there. So I think that for the law of numbers, right? Like we've heard, Microsoft can't get bigger than 10 billion and then 100 billion. And now it's at 1 trillion and it can't grow anymore. And the next thing you know, it's almost at 4 trillion. And so clearly they've been wrong every time in the past. I don't think that they're going to be constrained right now. I just don't. I think that if you think about the world, we need more software, we need more hardware, and we need a lot more automation that allows us to all do more with less, quite frankly. So this is what we need in the world. The demand for it is very high. And these companies can innovate faster than anybody else. They can spend a lot on innovation. and they can do it very profitably, just like they're continuing to do right now with AI. So I would say that it doesn't worry me too much. But I do think that we'll continue to see, just like we saw NVIDIA become the most expensive company or by market cap, we'll continue to see new entrances. I just think it'll be at a slower rate than it has been in the past because they can scale and continue to scale at a rate that other companies couldn't
Yeah, to your
traditionally
point
with high marginal cost.
Yeah, to your point about technology, low marginal cost companies, I would think if these companies are going to be replaced, it's going to be other companies with those similar characteristics that come from behind. I mean, not to knock GE, but GE is probably not going back in the top 10 in the S&P 500 anytime soon. Like, it's going to be these same types of companies, and maybe like an innovation like AI allows these same smaller versions of these same type of companies to come from behind and take on the leaders. That would be my guess if it's going to happen.
Yeah, that's exactly right. I mean, like you can be like Costco and you can be a great company, and we all love Costco, right? But like at the end of the day, their profit margin is like 1 or 2%, and they're never going to be like Visa and have a 60% profit margin. Nobody would shop there. So it's like they can't reach the same level of profitability mathematically. And they can't scale across the world like Visa can, like that. So like it's just like there's less upside in that company to me, and I wouldn't buy it, but I love it. I still love the company.
You and I were talking before we started about Salesforce and other companies, and this idea, like, it's interesting to me to think about how AI will impact like these big players. Like, some people are thinking, someone in their basement's going to create like a version of one of these companies and basically like take over this huge company. But you've also got to argue these big companies aren't dumb. They're trying to use AI themselves. They've got big brands, and so it's not going to be that easy. So I do think it's very interesting in the world of AI because you've got big companies that can leverage it really strongly. And then you've got the potential, at least, for smaller companies to do a lot more than they could with less resources. And it's very interesting to think about that balance.
So I don't want to offend any value people, but I really don't like small caps, especially in technology, because the stock-based compensation is like outrageous. Like, could you imagine like a company giving 30% of their revenue to like executives and they're not making any money? You know what I mean? Like It takes all the upside off for the shareholders. And so like, I think you see that quite a bit. While meanwhile, you have the large cap ones like Microsoft and Google, and maybe they're not growing quite as fast, but they're also doing buybacks, and their stock-based compensation is a mere single-digit percentage of revenue, right? So I think that there's more upside on the table for like the shareholders in large cap tech, and like we can go back, like I said, AOTG was born out of the really deep self-reflection and pattern recognition of the past, and so like. I mean, you guys know this. Growth has beaten value. Large cap has beaten all the other caps. Technology has beaten all the other sectors. Profitable companies have actually beaten unprofitable ones. And I think low marginal cost has beaten everything in my research. So like there's like a Venn diagram, and like there's a lot of overlap in low marginal cost and growth and large cap and profitability. So like all these things sort of overlap, but how do you capture that very best section of the market that kind of has sections that overlap with all these things that have outperformed historically? And like that's what AOTG tries to do.
Well, what you just got is something that all of us that are value investors, and I know some of our friends who are value investors as well, like we've all been debating, which is this idea that, large cap beats small cap and growth beats value is something that absolutely we can't argue has been true for 20 years, but it's not something that's true over 100. And so the question is, as something changed in the world with technology, and you could argue it has, where those types of things aren't going to work the way they have in the past because technology is introducing so much leverage into the system for these companies, or someday is value investing going to rise again? Like people like me will say, it's an interesting debate, I think.
Well, I think you have to like look at what Warren Buffett did, right? And like think about value investing 50 years ago, right? Or 70 years ago, because he was doing it in the 50s, right? So first thing, he went and bought around all the electric companies, right? So he sat there, these things were utilities, they weren't very expensive, but he recognized that every house was going to have a bajillion appliances. It was going to be bigger. Everybody was going to get air conditioning, and that demand for electricity was going to grow by 2000x. And he was right? So boom, he just got like a 2000x play there. And then he was like, wait, like, what if I bought all the insurance companies? And then like all of a sudden we mandate insurance on your cars. Like you have to have, if you're driving on the road, you have to have car insurance. And if you're getting a mortgage, by the way, you have to have house insurance. So like he figured out these markets that were going to grow by 2000x. And then there was other things like Coca-Cola. And he was like, I love Coke. I drink it every day, like 10 times a day, more than I should. But like I noticed other people don't. But as the US becomes wealthier and the rest of the world becomes wealthier, they'll be more like me. and they'll all drink Coke 10 times a day. So it went from being a luxury to being an everyday good for people that drink it. And that is enormous growth in those markets. The thing that's different today is that we don't have any demographic growth, and like those markets are already mature. So it's not like you're going to like make that money in utilities anymore, or like in car insurance, right? So like if anything, people are having, fewer kids in the world, and definitely in the developed world. So what that tells me is you've got less Coke drinkers in 20 years. You've got less people driving that need car insurance. You've got less people using water utilities, maybe less people using electricity. And you've definitely already seen that trend, by the way, in Japan and, Italy and Germany. All those countries are further along in their demographic decline than the United States is. But like, that's not good for those sectors. And you really have to question, like, what are the sectors that we're going to continue to need more of, just like Warren Buffett did 70 years ago. And he was absolutely right. Right. And then he got the smartphone right too, right, with Apple. But like, and then he got the credit cards right. Right. So he could see that there was these transitions happening, and he was right. But the real question isn't like Warren Buffett likes oil or Warren Buffett likes insurance, I should buy that too. The real question is like, how do you think like Warren Buffett did 70 years ago and spot that really high growth before it happens and before other people realize it's happening?
The other thing, I'm kind of going off track here, but value does tend to work really well, like at the low of the bear market, coming off the trough, coming out of those recessions. And, the business cycle here in the US has gotten like post World War II, we're seeing less and less recessions over time, probably due to a host of reasons. So it is a question, has something, and that would also maybe be a positive for some of these technology companies in the sense that they establish their leadership. They're kind of recession proof to some extent through the points that you brought up, John. And so, you get less explosive episodic value performance because we have less recessions, and these companies that are growth companies continue to grow. And actually we looked at almost like as, I know there's been certain points over the last 5 years where the market has seen weakness, and it's almost like these large cap growth dominant companies are almost looked at like as staples. Like their businesses aren't going to be affected. Like they're still going to be good coming through these periods. So just a couple of different points or observations there that could, be something around this underperformance of value relative to some of these other companies, more at a macro level, I guess.
Well, I mean, so like I'll give you an analogy. So there's Nutrien, right? That's a value company. It's a fertilizer company, retail fertilizer, and like potash mining, phosphate mining, right? So for them to grow, they have to make more mines. But the biggest thing is that we're not using any more fertilizer than we did 10 years ago. And if in fact, we're actually using less. And the way the world's going is we're going to continue to use less. And that's a good thing. There's going to be less runoff. There's going to be, the seed genetics are going to be better. So it's going to require fewer resources. So you have a slightly declining sector, right? And now for Nutrien to grow and for them to make more money, they have to win fertilizer business from somebody else. And do you think anybody like gives, oh yeah, sure, have my customers? No, people fight tooth and nail. So to win the business and value, you have to sell at a loss. You have to be like, I'm willing to lose more money than that guy will. And it's very expensive and it's funded by debt. Meanwhile, like take a company like Toast. Do they have a PE ratio of like 60 or 90? I'm sure they do. But like, think about this. They build this beautiful software system that powers everything for restaurants, and they sell it in the US. And it does, hey, your reservations here, or your online ordering, it processes your payments. It reminds all the people that work at the restaurant, hey, you've been staffed at this time. It's like a comprehensive restaurant software solution and payment processing solution. And it saves the restaurants that use it a lot of money. So now they have this thing, and they're just in the US. How much money do they make when they go and sell it out to the rest of the world? And how hard is that growth? I don't think the growth is hard. I think that because it provides so much value, people lose money if they don't use it, right? It actually helps them make more money. They actually can pay less in credit card fees, and they can actually like staff their business and use a lot less like management labor when they do that using the software. So like, I think that the growth comes much more easily, and it comes at very high profit margins. And so like mathematically, when I think about like, would I invest in this value company, or would I invest in the software company that is obviously much higher valued? I would choose a software company most of the time. Not every time, but I mean, in that case, I would.
Can you talk about this idea of digital toll booths? Because that was something I thought was really interesting when I was looking at your work.
Yeah. So So I think software as a service, and this is one of the things that killed me about the software sector, is like we all know that like Google and Robinhood and like Robinhood's a brokerage service, right? Google is, I guess, just in advertising and communication services. But we know that their core business is software development, right? Like they're building online platforms for people to use for their services, and it's powered by software. But they're not software companies because the software sector is software as a service, right? And so there are companies like Salesforce and Adobe that sell it as a subscription. But I just think that's like that's not a good definition of software because it's not what software is, and because software is like code that runs programs on computers, and so like you have the SEC definition of software, your sector definition doesn't match like the dictionary definition, which is problematic. But the other thing is that like there's barriers to entry when you have very expensive subscriptions. And I think the new model of software is, well, one, the model is we build it in the US, we sell it in the US, and then we sell it to the rest of the world at really high profit margins. And we surprise everybody by how much we can grow. So I think that's always true. But the second thing is to really take down the barriers of adoption. You make the software free. So like now you're a company like Visa, and really what you're doing is you're automating payment processing using software. So you're connecting somebody's bank account to their bank account and you're making that payment so somebody doesn't have to do it in cash or do a wire transfer or write a check. So you're saving tons of time and money for customers. You're saving tons of labor and you're automating things. We all know what software does, it automates. But then you're not charging a subscription for it. You're actually just taking a little fee of the money flowing through the system. So that is the digital toll booth. And I think that's the future of software, frankly, because it's just so scalable and there's no barriers to adoption. And so when you think about other companies that are doing this, whether it's like Toast with their payment processing for restaurants, or whether it's companies like Robinhood that, are maybe making their money not from charging the customers anything to make an account or even place a trade, but in other ways. Maybe they make it off their money market funds, or maybe they make it off of, payment for order flow. But basically, they're totally taking down the barriers of entry, and everybody can adopt it for free. And basically, you can just scale across the rest of the world in a way that has not ever been possible to do before. And that kind of rewrites the risk reward dynamic for investors at the same time.
When we think about toll booths and we think about all the other advantages you've talked about with these companies, one of the things that's interesting is if you look at history, and Michael Bobuson has done some good stuff on this on base rates. Like if you look historically, companies growing, 30, 20% a year, they always mean revert back down. And one of the things we talked about the Mag 7 earlier, one of the things they've defied is that logic. They've grown at rates that you would have thought would have not been possible at their size, given that historical work. So how do you think about putting that in context? This idea that, there is mean reversion in growth rates, or at least we think there is over time, but also something's changed in the world that maybe is like softening the blow of that coming back down. How do you think about that?
Yeah, I mean, I think that historically that's true. You can't just gobble up the whole world. I think what's different now is that these companies are making their own sectors, right? So like you're making a smartphone that didn't exist. You're making a FaceTime that didn't exist. You're making, payment processing that didn't exist. So they're making their own sectors. And then when they're done with that, they go and make another one, right? So it's like, oh, why don't we make Microsoft Teams? And why don't we make, right? So they're making these things so that you and I don't have to get on airplanes and do this video in person and spend days of work. Instead, now we can just spend an hour on it, and it saves us an enormous amount of time. And so like, I think the interesting thing is I really do think that this is a big frontier that's just getting started. And it's that software platform sector, which is low marginal cost, but it's really the digital infrastructure. So digital infrastructure replacing physical infrastructure. And like, just think about like the fiber optic cables versus people using Starlink, right? Like that's like a really good example of like, this is infrastructure that does the exact same thing. It just does it for 1/100th the cost. And the digital infrastructure saves people so much money that they'd be crazy not to do it. Could you imagine like us buying CDs instead of using Spotify? Like here you have this digital infrastructure that connects musicians. Like I could literally go upload a song on Spotify tomorrow. You wouldn't want to listen to it, but I could. And then people, if they like the person, they go and they listen to it right away. And so this saves tons of time. It saves tons of money, and everybody likes it more, from the musicians to the users like me. And so the digital infrastructure scales because it saves so much money, and it's going to continue to scale because there's a lot more we can automate and there's a lot better we can do. And the cost of automating that I think because of AI is going to continue to fall. So I think we're actually going to see an acceleration in this innovation. And that at the end of the day is really important for investors to keep an eye on, especially if they're worried about the rest of the economy, right? Like if people are worried, oh my gosh, like how's the rest of the economy doing? Well, you don't have to worry about that in this sector because there's really high growth rates and they're going to continue. I mean, do you guys remember like 2 years ago when like everybody was saying there's like a semiconductor glut and they're like
Yeah.
dancing on top of the cars, like Nvidia's down 75%, like there's a semiconductor glut. And I'm just sitting there, I'm like, every car is supposed to be self-driving. Every phone's going to be 5G. Everybody's backing up 250,000 photos on their phone and their Ring doorbell and everything. And like, do we need more semiconductors? And by the way, everything's going to use advanced robotics that have motion detectors and everything. I was like, yeah, it's hard for me to imagine a world that we have too many semiconductors. And to me, I was buying all those companies like AMD and Nvidia and Taiwan Semiconductors, and they were my biggest positions and they still are.
But that's the challenge, right? Because like, if you have two companies both growing earnings, let's say they have a 5-year earnings growth rate of 60%, and that's amazing. Like that's strong long-term growth. But then like, how do you, and let's say they trade at multiples of, I don't know, 60 PE. So it's whatever, a PEG ratio of 1, like they're expensive, expectations are high. One of those companies maybe has a path to continued growth. The other company does not. What in your mind, how do you differ? Like what would be the characteristics? And maybe you've talked about this, it's like low cost production aspect. How would you what would be the 3 things that you would look for in a company that would kind of tell you, okay, this company I think has a strong chance, even though expectations are high, to continue to grow. Whereas this company, kind of not so sure, because if the expectations are high and it trades at a multiple like that, on any disappointment, it's going to get crushed. So how would what would be the key things you'd look at?
So I think you just really have to look at the earnings growth. And I think you try not to try to tell the future too much. Like if the earnings growth is there today, that's the best indicator that the earnings growth will be there tomorrow, right? So like you try to look at like and like, by the way, like there's companies like Spotify that all of a sudden are, their revenue growth goes down. And, I start to reduce the position and put it in companies like Apple Oven that it continues to grow, at 77% year over year. So the average earnings growth in AOTG, the last time I did it is 35% year over year. So it is like much higher than 60% over 5 years. It's 35% over the last 1 year. I mean, what I would say is that like if you look at the earnings growth, so like take AMD for example. This is a trickier one, and I think it's important to understand like how you deal with like the special exemptions. And AMD had a CPU business, all right, and that's in decline because GPUs are replacing CPUs in data centers. Okay, so you have the CPU business going down, and you have the GPU business going up, and this one's going down at like 20% or 30%, and this one's going up at like 60%. So you look at the revenue and the revenue says it's flat, right? Year over year, flat revenue. And it's not rallying like the rest of the semiconductors, but you just do the math. Well, if that happens again, now that they're the same size and this one goes down 20% again and this one goes up 60%, well, in the next couple of years, revenue growth is going to be trending upwards to 60%, just like NVIDIA. By the way, they're growing their GPU businesses at like the same rate. So that the CPU business is masking the true revenue growth. But as that GPU sector becomes the biggest sector of AMD, it's going to reflect the revenue will reflect that. So there's certain scenarios where you can go off and say, hey, I can see there's going to be or I can forecast with some degree of high confidence that I think there'll be a strong revenue growth acceleration based on what I can see in the earnings. And you can see that quite often in companies as they come out with new products or new sectors that are growing, like Microsoft Copilot, right? So Copilot costs 6 times as much as Office. And I go to New York City, right? Like I'm at the NASDAQ and the New York Stock Exchange, and they're like, we love Copilot. We can't imagine our life without it, but nobody here in Iowa uses it. And so you can tell that the Copilot adoption is going to jump, and it's going to be 6x the revenue of Office. And like that's enormous growth. It's going to come at high profit margins, and like it's going to drive a revenue growth acceleration at Microsoft. And so I think there's times where you do that, but generally you try to focus in the today and what do we have here today? We're not speculating for the future.
Do you start your process with, I like this company, I know this company's products, let me look at the the fundamental growth rates, or do you start with like some screening growth rates and then sort of try to understand these businesses and dive into them? Because the one thing that I'm sensing here is that, you have a pretty solid handle of the business models of many of the companies, probably all the companies maybe in your portfolio. So how does that work from like an initial screening process all the way down to, do you think it's important to understand the story behind what's driving this growth?
Well, I think the problem is when you start trying to understand the story, you interject your own bias into it. So you don't want to like be like, I believe this company is going to cure cancer, and I'm like, or I really believe this weight loss drug is going to work. And you just try to focus on what the market is actually saying. And if they're buying the product, you see the revenue growth, right? And if they're valuing it, then it's right there in the numbers. I start with low marginal cost. So it needs to have low marginal cost. And then it needs to have the revenue growth on top of it, right? You're not going to buy it if it's shrinking. You're not going to buy it if it's, in the single digit teens. And that's not what like the growth indexes do, which are probably the best comparison to AOTG. Like the growth index is just like generally like companies like Apple make up like the largest position in most of them, like the VUG or or the Charles Schwab growth. And these companies are hardly growing faster than inflation. So I think when you have a growth portfolio, like you really the investors want high growth. That's why they want growth. And so I think like it'd be better to buy companies like AppLovin, which is growing its earnings or revenue. It's 77% year over year, and basically like have a portfolio that just has way better growth metrics. And a lot of times you're not even raising like the valuation, like the price to sales or the PE ratios much at all. So I think that's like a long-term thing that makes sense. But yeah, just low marginal cost and then take the earnings growth and the revenue growth from there.
And so it's like growth margin or profit margin you're looking at to get that low marginal cost ratio, like companies that are effectively more profitable, and then looking at the growth. Okay. And do you at all, I'm guessing you haven't mentioned it, but I'm just curious, like, do you at all ever look at like momentum, like relative strength, or no, momentum doesn't come into the price performance. It's all about the fund.
Quite frankly, I've actually seen my fund be on like sometimes I think Morningstar does like they rate you based on like your momentum score. And quite frankly, I'm on the opposite side of it, which is really interesting because the fund is actually, for quite a bit of time, I think like it doesn't have a lot of overlap, but the performance of some momentum funds has been very similar. So it's interesting to see you score on the opposite side at points, but have very similar performance or better, at times.
And walk us through, so your sell criteria would be, you see revenue, I'm guessing it's revenue and earnings growth start to tail off. You kind of say, okay, this looks like a red flag. Yep.
I mean, what's the benefit of low marginal cost if you're not growing? There's no benefit. Right. You're not getting any additional sales at 100% profit margins, so the earnings growth isn't going to be there. In fact, low marginal cost is dangerous if you shrink, because like we saw with Intel, right? Like if you start shrinking, well, that was all of your profit that you just lost. So now you're losing money. And so you don't want low marginal cost in shrinking businesses because that made up all their profit.
How about valuation though? Will you get to a point where you say this is a great business, it has low marginal cost, but it's just gotten too expensive?
Yeah. So I took Palantir out of the portfolio, right? I mean, I think that when you look at like a price to sales, you have to be really careful because you really have to think about like you could have Costco and it has a price to sales of 1, and you could have Visa and it could have a price to sales of 18. And you might be like, wow, look at Visa, so much more expensive. But Visa has like a 60% profit margin and Costco is like a 1%. So actually it's a lot cheaper. Like when you think about it that way. So I think that like you need to hold the price of sales constant, but when you see stuff like at 100 or like even 50, you think like that's going to be hard to get a good return over the next 3 years in that. So like if you can get the growth at like companies like Toast that have a price to sales of 3 or 4, and they have the high growth and they have the 400% net income growth year over year, then I think that's like a much better thing. And I pay very, very close attention to the valuation metrics, because at the end of the day, you want the highest growth, but you want it at the lowest cost. And so you don't want to pay 10x more than you have to for the growth. And I don't think that's a winning formula in the long run if you do that. Like by the way, like the indexes do.
What do you think about position sizing? Does that matter to you, or will you just let your winners, I mean, if something's working, will you let it run? Or do you kind of say, this is if something becomes like 15% of the portfolio, if it got to that high, would you pair?
Yeah, it's a tough question. It's a tough question to be like honest about, just because, nobody wants to cut their winners. They want to let them ride. but I'm an SEC diversified fund. So my 5% plus positions must be under 25%. So I actually have more like diversification by that rule than like the NASDAQ does. Like the NASDAQ, is 5% plus positions have to be under 45%. So they have they can take 25% more concentration than I can. So basically like for the past 3 years, right, I've been cutting NVIDIA at multiple points. I've been cutting Google, cutting Microsoft, and I like all these companies. I just was making, quite a bit in Robinhood, right? Like, Robinhood's up probably like 500% in the last year. And so I had to cut Robinhood. And I'm doing that, but at the same time, you're trying to move in, like you're trying to take the profits in those companies and still try to move it into higher growth at a lower valuation metrics. And I think that I always try to do that. Like I don't try to do a rebalance that lowers the growth of the portfolio and raises the valuation metrics. I always strive to do the opposite. And so far I think I have. So I try to use the rebalances despite not always wanting to sell my favorite companies to make the portfolio better and stronger every single time.
What's awesome about the ETF wrappers, you can get all these great long-term compounders. And like you said at the beginning, unless you sell the actual ETF, are you going to have to pay taxes on it? So you can get that long-term, especially for, someone that has, multiple years or maybe even decades, hopefully, in terms of their time horizon, they can invest in the ETF and let it sort of set it and forget it.
Yeah. I mean, I didn't even know about like the ETF tax benefits until, a few years ago. And gosh, when you know about it and then you learn that you were doing it in SMAs and you learned that you were holding mutual funds, you're like, what in the world? How did I know that? And I actually learned about it by watching YouTube videos. Like I watched ones with you guys and Wes, I think like 3 years ago.
Oh, sweet.
And I watched other ones. And so like the content you put out, like it really helps people. People don't know about these things. And so like why would anybody hold a mutual fund when they could hold an ETF that does the exact same thing in a taxable account, right? And so it's pretty important because ETFs benefit everybody. It's not like they just benefit me or you. If we buy it, they benefit everybody and they have the same benefit for everybody. And that's the magical thing about them. They're there to lower costs and raise long-term performance for people. And that's, yeah.
And where, if someone were to say, where this fits into, if an advisor comes to you and says, okay, where does this fit within is it kind of a satellite, like maybe somebody that have the core equity, and if they wanted like this, marginal low cost or tech exposure that would be like on the side with the percentage of the equity portfolio?
Yeah. I mean, you're asking the wrong person because I do it with like all my own money.
Nice. There you go.
So like
go all in, baby.
Yeah. I mean, the thing is that like the riskiest thing to me is in 3 years, you buy companies that don't grow and then, you lose money. Or you lose versus inflation, right? So like, to me, like the risk when you're buying profitable companies is just that they don't do anything for you in the long term or they lose you money. Whereas if you buy companies that are growing, it has a much smaller probability, in my opinion, of that occurring. So I know that, maybe if you're only buying Palantir, that's different. But if you're trying to do it at a reasonable valuation metrics, I think that there's a much smaller chance of that occurring. And so, I mean, I do it with almost all my money. I think that people could definitely look at it though as like a growth fund. And so if they like the Vanguard growth or they like the growth sector and they're comfortable with growth, right? Mm-hmm. And because investments are a judicious decision after all. And so if they like growth, they can think about this as a really good option for them that has done better historically than a lot of those other ones.
So we like to ask our guests 2 standard closing questions. And the first one is, what's one thing you believe about investing that most of your peers would disagree with you on? I think I know where you're going to go with this, but go ahead.
Yeah. So, I mean, I think that people, like the reason why people don't do what I do, right? And the reason why they don't buy like the technology sector, right? ETF, when it has had 22% annualized performance for 10 years in a row, is because they believe that the concentration is dangerous, right? And so they say that technology is dangerous. It's not something I can hold in my hand like I can with a car or a barrel of oil. So something's not right. And by the way, I live in Iowa, right? Like I hear this all the time, like, oh, technology, that's like, what is that? Like, that doesn't sound safe. And like, at the end of the day, like you want to own companies that are profitable and that can continue to grow and scale into the future. But the biggest thing is that they can continue to grow the value they provide people. So they're not just growing their revenue, but they're growing the utility they provide all their customers. And we all know companies like Google and, Microsoft and Visa do that. And so like that's not dangerous to me. That's actually something I embrace. And so while it's not like maybe like what your financial advisor would tell you, it's definitely something that has worked historically. And I think it will continue to work, in my opinion. And at the end of the day, people want to have the best returns in their portfolio for the most reasonable amount of risk. So I still stick to that.
It's awesome. And the last one is, based on your experience in the markets, what's the one lesson you teach your average investor?
I would say, you guys are going to croak, but I would say focus on large cap growth, right? Like, look, you know that growth is done the best. You know, large cap has done the best. You know, technology has done the best. Why not just focus on large cap growth technology? And like, that should be pretty hard to mess up. So I mean, but the other thing is that like, I think that a lot of people, when they get started out, and maybe I'm in a little bit different age bracket. So like, I see some people get excited about investing and they're trading options and they're trading on margin, and all that stuff makes me really nervous, just because like, I know I had a friend that like committed suicide because I think he was like so margined up, and then it went against him. So I think that like you should generally, like, I don't know. I don't really believe most people make any money doing that. I think they lose money and they take more risk than they should, and they don't manage the risk they take when they're trading on margin. So I think that that's like best avoided, in general. And then I think that like you really want to like Warren Buffett, I think you want to focus on companies that can continue to grow their earnings at 20% annualized in the long run. So like, if I was telling anything to anybody, it's like, explain to me why this company you want to buy has the potential to do that, and why you think it will do that. And I would just also say, avoid unprofitable companies. Like, why take the risk in a company that's going down the hill? Like, when you already have companies that are going strongly up the hill and you could just keep riding those. So I mean, I know it's not always like, like avoid the turnaround stories, but I that's what I do. I don't worry about those. And like, think like Warren Buffett when he was starting out, and think about what could be that 10x or 20x growth in the future.
Thank you very much, John. We look forward to following you and the success of the fund. We wish you all the best.
Thank you so much for having me. Appreciate it.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.